In this week's video, we'll examine history to help us answer the question, is Dow Theory telling us the stock rally is going to fail? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a chart of the S&P 500 February 14th, 1995. S&P 500 moved sideways for a long period of time. This is 1994, this is 1995 here, and finally cleared this high or broke out on February 14th. 2 days later, the Dow also was able to clear a high that was made in 1994. You can see it broke above that level on February 16th. From a Dow Theory perspective, what you would like to see is you would like to see the transportation average, or the Dow Jones Transportation Average, confirm this high that's being made in the Dow. A healthy economy, in theory, should have healthy industrial stocks and transportation stocks. Thus, they should be making new highs in unison or within a relatively short period of time to confirm each other. So in this case, in 1995, if I saw this breakout in the broader S&P 500 clearing this level here from a longer-term consolidation box, would Dow Theory have allowed me to buy this new high in the S&P 500? The Dow has done its part. It did make a new high. However, the transportation average did not confirm the new highs by the Dow and the S&P 500. This is the Dow Jones Transportation Average, or $TRAN, on February 16th, 1995. This is 2 days after the S&P 500 cleared this high here, and 2 days after the Dow cleared a similar high. Therefore, at this point, this looks worrisome. We're not even close to taking out this high here. This is what's known as a Dow Theory non-confirmation, and basically until the transports can make a new high, the highs in the S&P 500 and the Dow are not confirmed. We have a very similar situation in the present day. In 1995, the S&P 500 broke out of a long-term consolidation box and made a new high. The Dow did the same thing in 1995, and the transports failed to confirm these new highs. We basically have the exact same situation in the present day. The S&P 500 went sideways for a long period of time. It recently broke out. The Dow went sideways for a long period of time and broke out shortly after the S&P 500 did in 2016. In 2016, if we looked at the transports, similar to this situation here, the transports are nowhere close to breaking out. So similar to the situation in 1995, in the present day, we currently have a non-confirmation Dow Theory signal relative to the 2016 breakouts in the Dow and the S&P 500 index. From a historical perspective, how long in this case did it take for the transportation average to confirm these new highs, or how long did it take for these two indices to break down and confirm the lagging transportation index? Before we answer, remember the Dow and the S&P 500 break out in mid-February 1995. Dow Theory confirmation in the form of a new high from the transportation average didn't come until July 10th, 1995. Therefore, a logical question to ask, if we waited for the transports to confirm the breakouts in the Dow and the S&P 500, how much upside would we have missed? So to summarize, S&P 500 breaks out in February, Dow breaks out in February. If we were using Dow Theory, we would have basically said, I can't buy this breakout. I can't buy this breakout because I need this to confirm these breakouts. Moving back to the question, how much upside would we have missed if we waited for the confirmation? In the case of the S&P 500, here's the February breakout, here's the non-confirmation. If we fast forward in the Dow to July 10th, when confirmation came, we would have missed this huge move in the S&P 500 index. The specific answer to our question is, between the time the S&P 500 broke out and the time the transports finally confirmed it via Dow Theory, if we waited for that, we would have missed a 16.04% gain in the S&P 500 index. This is the move from the day of the breakout to the day that the transportation average confirmed this breakout, or July 10th, 1995. Let's answer the same question with the Dow. The Dow breaks out mid-February 1995. On that day, the transports are not confirming it. If we were using Dow Theory, we might decide to wait to buy this breakout. As we know, the transports confirmed in July of that year. How much upside would we have missed in the Dow if we waited until July 10th? This is the Dow here as of February 16th, 1995. The answer is quite a bit of upside. Between the time that the Dow broke out above this level here and the time that the transports finally decided to confirm this breakout, the Dow moved between point A and point B 18.21%. Now we're looking at the transportation average as of Thursday, August 25th, 2016, and you can see, similar to 1994, 1995, it's not even close to taking out this high here. Therefore, is Dow Theory relevant? We think the answer is yes. We think it's relevant. Next question. Is Dow Theory a showstopper? I think it's pretty fair to say the answer is no, because any signal that would prevent us from participating in a multiple month run in the Dow and the S&P 500, runs that could range somewhere into double-digit territory, is something that we probably want to use as one piece of relevant evidence rather than a showstopper. Dow Theory is based on the concept that the major indices should basically confirm each other, and we would be a little bit more concerned if they do not. So let's forget Dow Theory for a moment, and let's just talk a little bit about major indices confirming each other, and from a historical perspective, how important is multiple index confirmation. Now we're looking at the transportation average. This is 1989 where my cursor is. This is 1993 on the right side of your screen. Our question here: how did the S&P 500 perform during this 3.4-year period when the transportation average failed to make a new high? So here's a period here beginning on September 5th, 1989. It goes all the way to February 2nd, 1993. This high in the transports was never exceeded until literally years later. So a fair question would be, if we waited in the S&P 500 for the transportation average to confirm this breakout above this high here, how did the S&P 500 perform over this period if we decided to sit out due to a non-confirmation? And we're not specifically talking about Dow Theory here. We're just talking about major indices confirming each other. To answer the question, we've taken the S&P 500 and overlaid it over the exact same chart. So I can draw a vertical line here from the 5th of September 1989 and see where the S&P 500 was, and I can do the same. During this whole period here, the transportation average went sideways. This point here in 1989 is identical to this point here in 1993. During this period of quote-unquote non-confirmation, how did the S&P 500 perform? The answer is it gained almost 26% from point A to point B. In generic terms, the moral of the story: major index confirmation, so index A confirming index B, is it relevant? Yes, it's relevant. All things being equal in 2016, we would prefer to see the transports making a new high as the S&P 500, the Dow, and the NASDAQ made new highs. But as history shows us, is it a showstopper? Our answer is no, because we don't want to miss big gains while we're waiting for one specific piece of evidence. We make decisions based on the weight of the evidence. Relevant? Yes. Showstopper? No. If you're looking for some bullish hard evidence to offset concerns related to the Dow Theory non-confirmation, you can Google this title here and read about a volume signal that recently appeared. And last week we covered a long-term bullish signal that has only occurred 10 other times going back to 1982. You can find the information about that signal by Googling this title here, where my cursor is. If you want to learn more about Dow Theory, you should be able to find a CCM post by Googling this title here. Now let's shift gears and look at trends as of Friday, August 26th, after Janet Yellen spoke and after the intraday reversal. Since it's fresh in our minds, we'll use the moving average crossovers that we used last week, but I want to make it abundantly clear we don't use these moving averages here. These weekly moving averages were chosen last week for illustrative purposes only. Last week we asked 2 binary questions on one time frame. It was a weekly time frame, and our 2 questions were as follows: is blue above red and green, and are the slopes of all 3 of the moving averages up? We wouldn't recommend basing an investment strategy on something like this. Why? It may backtest very well over one period. It may not backtest very well at all over another period. So you want to avoid curve fitting. For example, there are periods in history where using just the 200-day moving average works quite well. There are other periods in history where using the 200-day moving average doesn't work particularly well at all. And the key is, during the periods when the 200-day moving average didn't work particularly well, there were other moving averages and other time frames that did work well. So instead of using 2 binary questions on one time frame, the portion of the CCM market model that asks questions like this, it answers 207 questions about multiple moving averages on multiple time frames. And that's our way of avoiding the downfalls of curve fitting your model to the data. We want to invest in a concept, not a particular curve fitted set of moving averages. Just to refresh everybody's memory, last week we used these 3 moving averages and covered a signal that has only occurred 11 times now since 1982, and we showed multiple markets using these moving averages to look at their health. So let's look at the same thing this week and see how those moving averages look today. Again, we're doing that for illustrative purposes only. We could have chosen numerous trend following methods to illustrate the same concepts. This is NYSE weekly in the afternoon after the Yellen talk and after the market turned red. NYSE weekly, in terms of our 2 questions, it still has a full bore bullish look as of 12:55 p.m. on Friday, August 26th. S&P 500, Friday, August 26th, 1:12 p.m. Eastern Time. Friday, full bore bullish look. Can't emphasize enough. We're using this to illustrate concepts. I could go back and look at the 207 questions and choose multiple time frames, multiple moving averages, and multiple binary questions, and basically at this juncture they would all be saying the same thing, which is the trends are trying to turn back up. And that statement is based on the data that we have in hand today in terms of flexibility. You can see here, this is not a particularly favorable look. If we're not flexible, then we won't be able to react to new data when the data starts to change. And that comment applies to the present day as well. Right now, on Friday, August 26th, this looks good. It tells us about probabilities based upon knowns today. If this changes and starts to look more concerning, and more importantly, if the 207 questions start to look more concerning, then we will consider taking actions based on the rules. For comparison purposes, this is the present day look, Friday, August 26th. Really doesn't look anything like this high risk period in calendar year 2008. These are the three same moving averages that we're looking at here in 2016. Similar situation, if we look at the dot-com bubble, the fastest moving average, blue, for the most part remains on the bottom during the entire bear market, and for the most part, the slopes of the moving averages are negative or down. We don't have anything like that today. Technology sector, VGT, we looked at that last week, August 26th, Friday, 1:15 p.m., continues to have a full bore bullish look. Contrast the present day look of this technology ETF with the concerning and high risk look of the same moving averages here in calendar year 2000, 2001, and 2002. Dow, Friday, August 26th, full bore bullish look. Present day really doesn't look anything like the concerning look in calendar year 2008 and into the lows of March 2009. Is it possible that the present day look morphs into something like this? Absolutely, positively, yes. But that's forecasting. We need to see the changes start to occur. They very well may occur, but they have not occurred as of 1:17 p.m. on Friday, August 26th. Bonds. If the market thought that the Fed was going to raise rates multiple times, and that's the key here, we'll cover that a little bit later, it's highly unlikely that these moving averages for IEF at 1:18 p.m. following Yellen on Friday, August 26th would look like this. They may change, but we don't want to anticipate that. We make decisions based upon what we have in front of us. Everything we just said about IEF applies to TLT, 1:19 p.m. after Yellen's talk, full bore bullish look. Let's look at a bearish ETF if we wanted to go short or inverse S&P 500. These are the same moving averages, 1:19 p.m. on Friday, August 26th. We have a full bore bearish look. We also have moving averages that were moving sideways in an indecisive manner here. We broke out of this box and we're printing a new low this week in the fastest or blue moving average here. All trends have counter trend moves. The trend in the VIX is down. We had a big counter trend move this week, but it really didn't do much to the moving averages. If we compare the look here, 1:20 p.m. on Friday, August 26th, to this look here, this is a high fear look, 2008, 2009. This really doesn't look anything like this. Last week we looked at this risk on, risk off ratio. SH killed VWO this week, but the trend hasn't changed in any meaningful way. And we're talking about long-term trends. We can't emphasize that enough. We're looking out weeks, months, and possibly years, which tells us we can have days, weeks, and even months where markets go down within the context of a long-term bullish trend. This still has a full bore bullish look in favor of emerging markets over shorting the S&P 500. This is what fear looks like in 2008, fastest moving average on the bottom, and the slopes of all of them are down. This is what the present day looks like. Let's talk a little bit more about Yellen's speech. Remember last week we had this quote from Alan Greenspan: "The United States can pay any debt it has because we can always print money to do that. So there is zero probability of default." This text here is from Yellen's remarks on Friday. She references a recent Fed working paper, and she also talks about in the next recession the possibility of implementing another $2 trillion in asset purchases, which is $2 trillion of QE. This is from the summary of the Fed's working paper that was released this month in August. The federal funds rate, which is really just interest rates, the federal funds rate now appears likely to settle down over the next few years at a rather low level. What does that mean? It means the Fed doesn't anticipate raising interest rates multiple times as they've done in the past when they start to raise rates. Therefore, that will limit the Fed's ability to combat the next recession. We've covered that before. You raise interest rates as the economy gets stronger, and the typical playbook is when the economy starts to get weaker, you can lower them. Well, if you're too afraid to raise them as they are now due to the high debt levels in the economy, it's going to limit your ability to deal with the next recession. Message to the market, no problem. The Fed should be able to compensate by using large-scale asset purchases and lower for longer forward guidance, which basically again sends a message to the market that if things start to go south seriously again, that we are not afraid to implement another round of large-scale asset purchases, or QE. One possible interpretation from the market, negative in the short run, that they may raise rates. But once they raise rates 1, 2, or even maybe 3 times, and that's highly unlikely, it's not very likely that they're going to raise them 5 or 6 times. And frankly, it's not really likely that they're going to raise them 2 or 3 times from here. Probably going to see either 0 or 1 more rate hike. And after that, we'll start getting promises about interest rates being lower for a longer period of time, and then we'll have the Yellen put potentially behind it, with the Fed saying that they're willing to start another round of large-scale asset purchases. Obviously, the market has to decide how to interpret all of this. These are hypothetical interpretations. From a hard data perspective, what is the market thinking on Friday after Yellen's speech at 1 p.m.? Mind you, this is after the markets have reversed and Fisher came out and said that September is on the table. The market still believes, based upon activity in the bond market and real money bets, there's a 70% chance the Fed does nothing in September. Obviously, this 70% is subject to change, but the way that we use this is the hard data that we have in hand right now, just as the trends that we just went over. That's the hard data that we have in hand right now. It doesn't predict the future. It just helps us ask this question based on the hard data that we have right now in front of us, facts. Are we allocated prudently? As of Friday, August 26th, the answer to that question for every one of our positions is yes, we're fine. We're in volatility to ignore territory, and of course, that is subject to change. Which is why, as always, we'll head into next week with that flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Showstopper Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.